G'day folks, welcome back to Pete's Investing. It's March 23rd, 2024. This is the natural gas price update. We're also covering some ETFs related to natural gas. Now in this video and every video we post, we're including a new table which shows the trends for various instruments, including some FOREX. But today for natural gas, the overall trend long-term is still bearish, but there are some possible bullish signs in the short to medium term. This is that table I was talking about with showing the trends on the monthly, weekly and daily. So you can see there there's various instruments including natural gas, Bitcoin, the S&P 500, but also some Forex pairs as well. And today you can see there for natural gas, monthly we're still in a short-term momentum. Weekly it's broken up into a neutral and daily it's long positioning. So there is some positive signs there at the moment. So first off, we'll look at the natural gas commodity price. We've got the weekly, the daily and the hourly. So what we look at first off is the trend. So down here you can see we've got two indicators for the trend. One is the ADX 25, that's showing bearish on the weekly. It's actually still bearish on the daily and bearish on the hourly. The CCO 150, and this indicator you can reference in the links in the description below to how to draw it with these moving average bands. When it's below the bands, it's a bearish outlook. And at the moment, you'll notice on the weekly, it's just broken up into the bands, so that's neutral. On the daily, it's broken above the bands, and that's daily. And on the hourly, it's bearish. So a bit of a mixed signal here, as I showed you in the table. So it possibly may break further to the upside if this weekly continues higher as well. Now, on the price chart, we also look at the CCO 150 as a divergence indicator. So let me just expand the weekly first off. So the CCO 150 back here with lower highs versus higher highs on the price. We had two peaks there versus the CCI, and it actually fell off the first time, and then the second lot fell off again. And that second drop was a lot more extensive than the first drop. And what we do is we typically take the Fibonacci to understand how do we measure the drop. We take a minimum 23 to 38% retracement. So that first Fibonacci retracement, in this case, fell just above the 61%, and that's a key area to look out for. We typically choose the 23-38% as a target for these divergence, and we always go back to the previous low before that divergence started, so we take it back to that point there. In terms of the second the second divergence, we'll take that, if I was to draw that to that point, you can see there it fell below the 61%. It actually touched it the first time, bounced, and it's just as our curiosity, let's see what it did on the first bounce between that Fibonacci range. You can see there that wick hit the 61% and then bounced down again. So we always look at the retracement predominantly as opposed to the extension on Fibonacci's. That gives us a good indication of where it's going. If it can always, the 61% is key because it could always bounce from there like it did here, then it hit that 61% on that little retracement, and then it reversed. So that was a reversal twice in that area for the 61%. But the second level, it actually fell below the 61%. In that case, it went well beyond, around about 100% level, and it stabilized there. It's dropped a bit lower. So at the moment, it's been fluctuating in that range. As you can see, for all of 2023, and so far this year, it's actually dropped a bit lower. On the daily, again, we had another retracement there, hit that resistance at 61%. And that resistance was at 31.20, and more recently we're seeing it stabilize and bouncing off this support at 15.84 and off that minor resistance at 20.58, and it's been going sideways since. And lastly, on the hourly, I've got these arrows in there, these bullish and bearish arrows, and that's off the stochastic 7 period, and that's fairly accurate. As you can see, it's picked the highs and lows generally along most of the price action. As well, I've got these trend lines. You can see there the price has been hugging those trend lines very nicely. Here it's starting to fall away a bit. If I was to draw another trend line along those bottoms, you can see there it's just starting to fall below that second trend line there. If I bring it out to there, that's still making a lot of touch points along there, so that could be a key area to look out for. So we may see it bounce from there, and this stochastic indicator showing it potentially may bounce, but the CCO 150 trend is showing a potential drop, so just be careful of that. Also, we look at the CCO, as I said, as a divergence indicator. We had a small bullish divergence there versus the price, lower lows versus higher lows, and the price then retraced to the upside. In this case, it made a small retracement compared to the price action, and it kept rising since then. Next, I'll go through the ETFs fairly quickly. The first one is BOIL, ProShares Ultra Short DJUBS. So you can see there the ADX is still bearish, although the CCI 150 is showing a bullish divergence versus the price. So that's a slightly positive view on the weekly. On the daily, likewise, we've got a bearish ADX versus a bullish divergence on the CCI versus the price, and the price has bounced off that support at 1346. On the hourly, bearish on the ADX, but bullish divergence on the CCI 150 versus a double bottom, almost a triple bottom on the price. Again, it's bouncing possibly off that support at 1346. So for KOLD, bullish movement on the ADX on the weekly, bullish movement on the CCI 150. On the daily, bullish on the ADX, but neutral on the CCI 150. And we did have a bearish divergence there versus lower lows versus higher highs, lower highs versus higher highs on the price. It's actually bounced and hit our target, bounced off the 61%. And on the hourly, bullish on the ADX, bullish on the CCI 150, and you can see there, it's actually retraced up to the 61% and currently stabilizing around between the 50 and the 61%. So we may see further rise up from there as well, if those stochastic arrows have any indication. But just be mindful, the daily is showing a bearish candle and a potential downswing. Lastly, we have UNG on the weekly, bearish ADX, a bearish outlook with a bullish divergence on the CCI 150 versus lower lows on the price. So we may see a bounce from there, and that stochastic arrow gives us some indication. Bearish on the ADX, bullish divergence on the daily, on the CCI versus lower lows. It's bounced double bottom off that support at 1457. So again, we may see a bounce from there. And on the hourly, bearish on the ADX and currently neutral on the CCI 150. But again, that's in line with the weekly and daily. It's possibly going to bounce from there. What I've got here is a trading idea. We trade on the Heikin-Ashi, and the price chart shows a Heikin-Ashi going long on a Heikin-Ashi when it's green, or short when a Heikin-Ashi is red. That's one rule. But the main rule is we only trade on the hourly. These two charts here are the hourly average down approach and the hourly stop loss approach. We only trade on the hourly when the daily is showing the long signal when it goes long, or going short only. In this case, I've taken the back test to the 20th of February, back there when that CCI broke above the moving average band. So you go long, and you would have stopped the trade when it broke into that moving average band, taking no trades long or short when it's within the band. You might have got into a short position there, but you would have probably stopped it out very quickly once it broke up again, and you would have gone long again when it was above that moving average band. Again, I prefer to trade long in this case when the weekly and the daily are aligned, both long, although you can do it on the daily alone. So you can see there on the back test where it started back here on both the average down and the stop loss, and you would have stopped out at that point when it dropped in the moving average range. The average down approach generated $7,000 and a stop loss approach generated $2,220. These are the rules for the average down approach. So I'll get you to pause the video and read that in your own leisure. And these are the rules for the stop loss approach. To support us more, go to the Patreon page for Pete's Investing, where we also do weekly scans of blue chip shares that are trending along on a longer and medium term timeframes. Feel free to support us there, and we'll see you in a future video.